Over here in East Africa, a debate continues to rage on in Kenya on whether or not President Uhuru Kenyatta will sign into law a bill passed by members of parliament designed to put price controls on retail interest rates. Now, the central bank and the Kenya Bankers Association are united. They're speaking on one voice on this. They've opposed the plans by legislators to cap rates. They argue this will have extremely adverse effects, including the promotion of informal lending channels like shylocks. President Kenyatta, for his part, he has pledged to consult widely before making a decision after Parliament's move this week. Now, the bill also pegs a minimum interest rate payable on deposits held in interest-earning accounts at 70% of the central bank rate. That's the main policy rate over here. The banking sector regulator has warned that if the bill is signed into law, it will create massive inefficiencies in the credit market, credit rationing, the promotion of informal lending, and of course undermine the effectiveness as a whole of monetary policy transmission. Let's dig deep into the details of exactly what's going on here. Shylocks is the CEO of the Kenya Bankers Association. Is with me in studio right now. Thank you for your time.
Thank you.
What are your initial impressions of this bill when you first saw it?
I think one of the critical things about the bill is the fact that, for instance, Kenyans have not been really educated on the implications of the bill. The impression that has been created in the market is that when the bill is passed into law, then Kenyans will be able to access cheap credit from the banks. But the reality of the matter is that the risk profile of the borrowers has not changed. So what will happen is that banks will now be obliged to only extend credit to those who meet the profile that has been prescribed within the law. So any borrowers who are above that whose risk profile is higher than what is prescribed in the law will now have to look for credit elsewhere outside the banking system.
Speaking of the credit profile, because this is a contentious argument, a lot of the banks that are members of the organization you represent haven't been particularly responsive to using credit scores in order to actually provide differential pricing for lending rates, especially for many of their clients. We still see in this day and age, in the first quarter, for example, average lending rates around 17–18%. But if you look at individual bank lending rates, you've got some that are lending as high as 20% on average. Why aren't credit scores working?
Well, I think we also need to understand where we are coming from. The introduction of the credit information sharing mechanism was, first of all, started with negative information sharing. And that's because the law, for example, had to be changed to allow banks to share information. It's only subsequently that, again, the law was amended to allow mandated sharing of positive information. Now, it's only on sharing positive information that really the mechanism becomes effective. What we are saying is that the implementation of the credit information sharing mechanism has taken a bit of time. But now banks are clearly beginning to employ the credit scores in their credit appraisal.
Well, in my case, that really hasn't happened, because I would say I have a fairly decent credit score, but if you look at essentially the pricing mechanism that's applied in my case, it's a completely different matter. It's remained static at 19% for a couple of years now. So, and my experience is not alone, because we had this conversation on Twitter earlier on. A lot of people keep saying that, look, banks consistently say, we'll lend you money, but the fact of the matter is that pricing doesn't reflect either KBR or the credit score that people put forward.
Yeah, but one of the things you need to factor in is the fact that even though the mechanism has been put in place and you're trying to build on it, because we are trying to ensure that the implementation goes through the full cycle, it hasn't been fully implemented. The credit information sharing bureaus that we have do not have the full information. So banks are still struggling to get the full information available on the borrowers.
Okay,
so as that builds up...
Help me understand this. When you say full information, what exactly are we talking about? Because the CRB will already have details on prior loan service, if defaulted on anything. In some cases, they'll have information on whether or not have defaulted on mobile loans, utility payments, and so on and so forth. So from a bank's perspective, what more do you need?
Now, like for example, not all utilities, not all service providers, not all credit providers are within the mechanism. It started with the banks, then a few of the credit providers have been put into the system. We now have Higher Education Loans Board in the system. We have a few of the microfinance institutions. We have got the circles coming in, but they have not been fully incorporated. By the time we get into the utilities, now we'll have the full information about a borrower. So, like for example, myself, you would have information about my borrowing from the bank, but not from the other credit providers. That does not give the full picture of the borrower. we are traveling that journey because soon we'll actually have that information available. Within the credit information sharing mechanism, we now have utilities coming on board. And once they come on board and they start providing the information, then now the full mechanism will be applicable.
When will that happen?
It's something that we are working on because the CRB association is now working on trying to bring on board the other credit providers other than banks.
Right, one last question for you. It is mandatory for banks to have this information, but should we make it mandatory for your members to essentially act on that information? Because right now it clearly isn't happening. So say, for example, if someone comes to you, they've got a credit score of 400, obviously they won't qualify. If someone comes to you and says, I've got a credit score of 700, 750, which is essentially on the up end of the scale, shouldn't that essentially qualify them for differential pricing without any recourse to anything else, purely based on that score?
Actually, right now what we're working on within the bank association is to try to ensure that banks are actually using the credit scores to risk price their lendings. And it's something that will eventually, take a bit of time because we have got to get the system working. One, if they don't have the full information, they wouldn't be able to rely on it. So they rely on the credit scores plus additional information they've got to get to be able to risk price the project. So eventually, I see the mechanism becoming, prevalent, and borrowers basically being risk priced as the mechanism picks up. But it will take a bit of time. It's not something that will be immediate.
Right, we'll have to leave it there for the time being, unfortunately. We're running out of time for that segment, but thank you for your time as always.
Thank you.
We've been speaking to shylocks, the CEO of the Kenya Bankers Association. Of course, this conversation will continue on and offline.